How have markets performed? Global equities have recovered their early year losses and are now flat year to date in local currency terms, although are still down approximately 2% in euro terms due to a slightly stronger euro. The 14% rebound from the February lows has been driven by easing of global recessionary fears, policy measures from global central banks, improved sentiment associated with the rebound in oil prices, and greater comfort regarding the stability of the Chinese economy and currency. What did the ECB announce in March? In contrast to the December policy meeting, the ECB surpassed investor expectations with policy measures announced at its March meeting, which were significant both in terms of their size and breadth. The level of asset purchases was increased by €20 billion to 80 billion per month, while non-financial corporate bonds will be included among the assets purchased from June onwards. New long-term refinancing operations, or LTROs, were announced, whereby banks will be able to borrow from the ECB at rates as low as -0.4%, depending on the level of loan growth generated by individual banks. The main refinancing interest rate was cut to zero, while the deposit rate was reduced by a further 0.1% to -0.4%. The measures went some way towards addressing the credibility issues which had arisen in relation to global central banks and their ability to announce policies which can impact economies and markets. There was some disappointment at the ECB's suggestion that it did not expect to reduce the deposit rate further in the future, but this appeared to reflect an apparent agreement at the G20 meeting in February to a truce in the currency wars which have been evident in recent years. The resultant weakness caused in the US dollar helped ease some of the previous devaluation pressure on the Chinese renminbi, which had been acting as an overhang on markets earlier this year. Despite the disappointment at the deposit rate guidance, markets ultimately, however, focused on the more positive aspects of the ECB's policy announcements, which contributed to the rebound in markets. What impact did the US Fed have on markets? The US Fed helped confirm that central banks still have an influence on markets. At the March meeting, the Fed reduced its forecast for the number of interest rate rises in 2016 from 4 to 2. The tone of commentary, however, at the post-meeting press conference and in subsequent speeches by Chairperson Janet Yellen were very dovish, emphasising a very gradual and slow pace of future interest rate rises, with investors interpreting the comments as suggesting an even slower pace of rate rises than in the official Fed forecasts. By hinting that the Fed was willing to keep interest rates lower for longer and was willing to let the economy run a little faster and even allow inflation potentially move above its 2% target for a period of time, the Fed indicated monetary policy is likely to remain relatively accommodative for some time, and this was well received by markets. What has been happening on the economic front? Earlier fears of a global recession have continued to ease. As seen in the Citi Economic Surprise Index, which shows how economic releases compare to expectations, economic data has tended to improve since the end of February, with the majority of data points across most major economies surprising positively over the last couple of months. In particular, in China, following additional fiscal and monetary stimulus initiatives, PMI sentiment indicators and export data have rebounded significantly, while infrastructure spend, lending, the property market and general activity levels have also improved. Elsewhere, while Q1 GDP in the US is likely to have been soft at between 0.5% and 1%, ISM sentiment readings, particularly in manufacturing, have shown strong rebounds, while the labour market and consumer confidence levels have remained firm. In Europe, while sentiment surveys have been slower to rebound, activity levels have been better, most notably with stronger industrial production and retail sales, which have been consistent with Q1 GDP across the Eurozone of about 2%. While growth remains modest and below pre-crisis levels due to low productivity growth, ongoing deleveraging, and slow investment spend, global growth is expected to remain positive and remain in the 2.5% to 3% range in which it has been over recent years. Market outlook. Equities remain supported by a modest but positive economic growth backdrop, with the recent improvement in macro news flow expected to continue in coming months, while monetary policies from central banks also continue to be supportive. Equities remain extremely attractive on a relative valuation basis compared to other assets such as cash or bonds, given the low yields available on these assets. While there is still some upside in equity markets, it is, however, likely to be more modest than the gains evident from the lows in February, given that in absolute terms, equity valuations are now back in line with long-term averages, while earnings growth remains modest in mid-single digits. The upcoming UK Brexit referendum on EU membership will be closely watched by investors, with the result expected to have an impact on markets. While current polls suggest a very close outcome, our base case remains that the UK will vote to remain in the EU, which will probably have a positive impact on markets.